BP shares moved higher after it reported a 71% rise in first quarter profit, partly thanks to a sharp rise in the price of oil. Underlying replacement cost profit hit $2.6 billion, surging past analysts' estimates. Joining me now is Aneeka Gupta, Associate Director for Research at ETF Securities. Thanks so much for coming in. So it was the strongest quarter for BP since 2014 for the upstream business. The downstream business was also pretty robust. What did you make of the numbers?
Well, like you said, BP's numbers were very, very strong. Largely, their net income has come up about 42%. This is largely on the back of strong upstream and downstream profits from earnings. We've seen upstream rise by about 12% and downstream profits also increase 18%. I think this has helped the earnings numbers so far. When you try to compare them with Shell, you see quite a big difference. Shell's net earnings have been has risen 42%, whereas you can see that their free cash flow is actually flat for the year.
So what's driving the difference in the cash flow? Because as you mentioned, we got operating cash flow increase for BP to $5.4 billion, but it was a real weak spot for Shell.
True. So for the downstream profits, we've seen a decline owing to a very reduced refining and trading margins, which actually dented their profits quite a bit. So I think that was one of the downsides for them.
And what did you make of the sort of debt picture when it comes to BP? Because we saw the gearing level rise up to 28.1%.
Right.
Is that because of the Deepwater Horizon oil spill? We saw that there was a charge relating to the settlement of $1.6 billion. Can we really excuse it just because of that? Or is there something more broadly going on in terms of the gearing situation?
No, it's exactly like you said. They've had a one-off payment for the Macondo projects. They've also had to make a payment to the DOJ. So this has largely contributed quite a lot to the increase in the debt. But apart from that, generally in the first quarter, we see inventory starting to pick up. So that inventory build actually weighs a lot on their debt, which is why you've seen a considerable rise in their debt levels.
Now, with the Shell numbers, I know we mentioned the cash flow was a bit of an issue, but the actual earnings were pretty strong. Why do you think investors were slightly alarmed when you look at the share price reaction on the day?
Yeah, I think that all boils back down to the fact that investors have held on to these shares for a long time. They've been through the two-year route where oil prices were low. The stock hasn't done anything. Now that the oil prices are back, investors want to be compensated for that time that they've held on to the stock. And clearly, the CFO has not given the go-ahead for the $25 billion worth of share buybacks. And you saw the stock price reaction, which was completely contrary to what we've seen with BP.
Now we know BP is making progress on its share buyback program. Shell is a little bit behind. Do you think we'll see that come through soon? I know it's pledged to really get going with that by 2020.
Right. So there is an issue. So it is there in the plan from 2020 to 2022, but as of now, the CFO, I mean, even on the conference call with the CFO, she's by the time we reached the end, there was like no more calls, no more questions on on the share buyback. So I think for now, the guidance is it is in the plan, but it's not going to be executed as of now.
What do you make of Shell and BP from a dividend perspective? Because I spoke to one income investor the other day who was very encouraged by Shell with a 5.5% yield. He said this stock actually looks very attractive.
Right. So in the case of Shell, we've seen the dividend yield at about 5% right now. I think when you compare the two, if you look at the valuation, so Shell's valuation is a bit lower than BP. Although you're seeing a stronger dividend yield for BP, I think investors are going to see a better price discount in Shell stock versus BP.
So let's take it back to the broader oil market now. There's one hedge fund coming out this week predicting $300 oil. Where do you see the price going from here? I know it's the multi-million trillion-dollar question.
Right, yeah. Well, for us, our view is that oil prices are going to be, they're going to be trading within this range, and it's going to be very volatile. So obviously we've seen geopolitical risks weigh in on prices very heavily. Just yesterday we've seen Benjamin Netanyahu claim that, Iran has been holding back on the nuclear initiatives that they've had within the country, and that's also been playing on oil. So it is quite evident that oil prices are going to be under significant pressure, and we expect that to definitely weigh on the profits.
And do you think that what's driving oil at the moment is based on supply and demand fundamentals, or do you see it more being driven by the speculative hedge fund long positions?
So it's a bit of both. For sure, when we, back in 2017, the emphasis was that there's going to be U.S. shale demand is increasing, it's ramping up production, and that's going to, put in excess supply into the market. But what we're seeing now is that over the course of 2017, OPEC has actually stuck to its production cuts. Not only that, we've seen in Venezuela, there's been, the outages in Venezuela has actually contributed to OPEC sticking to its production cuts, and overall the production has come off quite a bit, which has helped them because you've seen a sharp spike in prices, which is benefits them as opposed to U.S. shale producers. So I think the supply demand eventually does weigh on market dynamics in terms of seeing where the price is, and to a small extent you have the speculative positioning moving prices and giving you that volatile range.
Now we've got this looming Saudi Aramco IPO. There's a lot of speculation about when and indeed if it's actually going to happen. Do you think as long as that's in the pipeline, that's going to keep oil prices high?
So the intention is that they want to keep prices high ahead of the IPO and the new initiative to diversify the economy away from just energy assets. So the intention is to keep oil price high, but eventually, like I said, the long-term price will be determined by supply-demand dynamics. And so far, Venezuela has contributed in a big way. OPEC has contributed in a big way to keep production quite tight. But as long as U.S. shale, which is quite flexible, keeps pumping that oil into the market, we will see oil prices shift a bit lower going forward.
Now we've also had a number of earnings out of the US oil space as well, Exxon being one of them. And you pointed out the fact that Exxon and Shell had very, very different results when you look at the profit line and the cash flow line. What's driving that divergence?
Well, in the case of Exxon, it was quite a startling result because obviously production was down. It's been, the first quarter production was one of the lowest misses in 19 years.
Which is interesting given where the prices are.
Exactly. But I think, in the case of Exxon, it's purely because of there's been a slowdown in the margin. So I think that affected prices quite a bit. What some investors aren't really focusing on is that it was their decision to actually reduce debt as opposed to just take an initiative on buybacks. So I think for Exxon, it's a focus on a longer term initiative rather than just pleasing investors at the current stage. So I think investors are overreacting in the case of Exxon, and I think if you look at the long term picture, they're quite a strong company.
I spoke to one investor who said that trading oil stocks is a game for traders rather than investors, because essentially you don't really know where the oil price is going to go if you want to hold on to these stocks in the very long term. What do you make of that?
Well, I think that and the energy sector has been through quite a hard time, so I would definitely agree with that. But going forward, I would say that oil prices will start to trade. They have been within a range. I think of late, there's been a sudden spike due to geopolitical tensions. Going forward, it will be within quite a tight range of $60 to $70 per barrel. And once that happens, you'll see earnings and profits start to sustain and stabilize, which is, I think, what investors are looking for, which is why we haven't seen the energy stocks actually catch up with underlying Brent and crude prices. So it is going to be a very volatile sector, as is the entire market at this stage, because there's a premium that geopolitical tensions is playing into the price, which is what we're seeing. But going forward, I think there will be a tight range that it will stick to.
Okay, Aneeka, thank you so much for your time. That was Aneeka Gupta, Associate Director for Research at ETF Securities. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you very soon.